My name is Jacob Shelton. I'll be your host of today's webinar. Thank you for joining. We'll be focusing on some of the investment options that U.S. expats have around our retirement accounts as we're living abroad. Many of these points can also be relevant to our brokerage accounts, although there can be more options on that side of things. Please keep in mind that these will be generalized statements, and what I say might be different depending on your specific country you reside in. If you have questions on a country's particular treatment of an account, please feel free to schedule a free consultation with me for a later date. I myself am an expat living in Marbella, Spain with my wife, Emma, and my golden retriever puppy, Daisy. For the first 8 years of my career, I was in wealth management in the States, working at Morgan Stanley first and then JP Morgan. So I understand the many challenges that US citizens encounter as we invest normally, and even more challenges with our investments when we move abroad. To start, we will discuss different retirement types that are common and different options for those. Next, we'll speak about how US expats are able to manage these accounts and what changed from living in the States. Finally, we'll speak about the actual underlying assets to invest into, and despite some misunderstood laws, how our portfolio can be quite similar to what you were able to have while you were in the US. Let's start with 401k plans, a cornerstone of many Americans' retirement strategies. These employer-sponsored plans offer significant tax advantages. When you contribute to a 401k, you're using pre-tax dollars, which lowers your taxable income for the year. Your money then grows tax-deferred until withdrawal. For expats, it's crucial to understand how your 401k fits into your international lifestyle. If you're still employed with a US company, you may be able to continue contributing. However, if you've left your American job for a different one, you still have several options. One is to leave the money in your old plan, if that's allowed by the plan provider, which it typically is. Two is to roll over into an IRA at a cross-border compliant institution. Or three is to transfer into your new employer's plan if they're US-based and have one available that allows for foreign addresses. Each option has pros and cons, especially for expats. For instance, rolling over to an IRA might give you more investment choices, but it's essential to work with a provider who understands expat issues, including preparing the correct tax reporting documents for the US and for your new home country. With rollovers for expats, timing is crucial. You want to consider factors like currency exchange rates in your current versus future tax bracket. Remember, the US government views a 401k distribution as taxable income, even if you're living abroad. So we want to make sure that we do this rollover correctly and in a timely manner, which can save considerable taxes. Moving on to individual retirement accounts or IRAs, there are two main types, traditional and Roth IRAs. Traditional IRAs work extremely similarly to 401ks. Contributions are often tax deductible and growth is tax deferred until withdrawal, which is then treated as taxable income. Roth IRAs, on the other hand, are funded with after-tax dollars. While you don't get an immediate tax break, your money grows tax-free, and qualified withdrawals in retirement are also tax-free. For 2024, the contribution limits for both types is $7,000 if you're under 50 years old and $8,000 if you're 50 or older. However, eligibility and the ability to deduct contributions depend on quite a few factors like your income and whether you're covered by a workplace retirement plan. As an expat, there are additional tax implications to consider. The Foreign Earned Income Exclusion, or FEIE, can complicate IRA contributions. If you exclude all of your foreign income, you might not be eligible to contribute to an IRA for that year. However, if you have US sourced income, foreign income above the FEIE limit, you may be still able to contribute. This option might make sense depending on which country you reside in and their income tax rates. If you live in a lower tax country and have remaining taxes to pay on your income in the US, then this might be a good option for you. If you're in a higher tax country and typically don't have to pay any income taxes in the States, then this would most likely not make sense. For business owners of a US-based company, a SEP IRA might be a great way to lower your taxable business income and save for your future retirement while still creating this tax deduction. It's worth noting that some countries may not recognize the advantageous status of your IRA, potentially leading to double taxation. This is why it's crucial to understand both US tax laws and the tax laws of your country of residence. While 401ks and IRAs are the most common, there are certainly other types of retirement accounts you might encounter depending on your profession. These include 403b plans, typically offered by public schools and nonprofit organizations, 457 plans, often used by state and local government employees, and the thrift saving plans for federal employees and uniformed services. These plans share many similarities with 401ks, but there can be important differences in contribution limits, investment options, and distribution rules. For expats, the key considerations remain largely the same. One is, can you continue contributing when you're abroad? Two, how does your country of residence view these accounts for tax purposes? And three, what are your options for managing these accounts from overseas? Remember, maintaining these accounts while living abroad can be complex. Many US-based advisors may not be equipped or regulated to handle expat situations, which is why it's crucial to work with financial professionals who understand the unique challenges faced by Americans living overseas and who are licensed to work with foreign residents, and especially in the country in which you reside. Now, let's delve a little bit deeper into the differences between traditional and Roth accounts, as this decision can significantly impact your retirement strategy as an expat. The primary difference lies in the tax treatment. With traditional accounts, you get a tax break now, but you pay taxes on withdrawals as income later. With Roth accounts, you pay taxes now, but get the tax-free withdrawals in retirement. For expats, this decision becomes even more complex. You need to consider your current tax bracket, first your expected tax bracket in retirement, the tax laws and treatment of each account in your country of residence, potential changes in US tax laws and RMD and retirement ages, RMD being required minimum distribution, which, as we've seen, has been a moving target over the past 10 years. And also your overall financial goals, such as estate planning and maybe giving to your children. Roth accounts can be particularly attractive for expats in certain situations. If you're living in a country with lower tax rates than the US, paying taxes now on Roth contributions could be advantageous. Additionally, Roth accounts offer more flexibility as you can withdraw contributions, although not the earnings on those contributions, without penalties before the retirement age of 59 and a half. When it comes to rollovers, expats have some unique opportunities. For example, you might consider converting a traditional IRA to a Roth IRA in a year when your taxable income is low. This could happen especially if you're taking advantage of the foreign earned income exclusion. And this backdoor Roth that we've seen so much about in the news over the last 20 years could be even more advantageous potentially for expats. Now, in your long-term planning, you need to consider how many years before you'll actually need to access this Roth account. Will this Roth account be a part of your personal estate plan? And remember, Roth IRAs don't have required minimum distributions, which can be beneficial for estate planning or end-of-life giving. How does your country of residence tax withdrawals from retirement accounts? Some countries might not, such as Spain, might not recognize the tax-free status of Roth withdrawals. In Spain, actually, you still get taxed at the beginning before you contribute to a Roth, and you still get taxed as income when you pull from that Roth as well. Another consideration is what other assets do you have? Diversifying between traditional and Roth accounts can provide tax flexibility in retirement, especially if you're ever planning on moving back to the States, keeping your overall tax rate low. Balancing Roth accounts with other assets is crucial. They can serve as a tax-free pool of money in retirement and complement your other taxable income sources. No matter in which country you currently reside, it's extremely important that you keep your retirement accounts custodied within the United States. If anything from this webinar, that could be the most important. No other country has the ability to receive 401ks, IRAs, or any other type of US-based retirement accounts and maintain their tax structure. Moving these accounts to another institution that claims to be able to hold them offshore can lead to some dire tax consequences. Which brings us to one of the largest challenges for expats. The biggest hurdle is finding qualified financial advice. Many US-based advisors are not equipped to handle the complexities of expat finances and the vast majority are prohibited from working with overseas clients due to regulatory constraints. It might be tempting to use a US address to maintain relationships with US financial institutions. However, this approach carries significant risks. If discovered, it could be seen as fraud, potentially resulting in the forced liquidation of your assets. Always be transparent about your residency status with your financial institutions. Accessing your retirement funds while living abroad can be tricky. Some US financial institutions may restrict or freeze accounts for overseas residents due to concerns about money laundering or regulatory compliance. It's crucial to work with institutions that are experienced in serving expat clients. I'm actually working with a couple right now that just received a 60-day notice from my old company, JP Morgan. Their accounts are currently frozen, and we are rushing to open new ones so that when the accounts are liquidated, they won't have a tax consequence from liquidating their IRAs and have a new place to hold these funds that is custodied within the United States and keeps that tax efficient structure of that IRA. Estate planning adds another layer of complexity. US retirement accounts are subject to US estate tax laws, but your overall estate may be subject to estate or inheritance taxes in your country of residence. Careful planning is needed to avoid double taxation and ensure your beneficiaries can easily access the funds. Beneficiary designations are particularly important. Make sure they're up to date and consider the tax implications for your beneficiaries, both from a US perspective and in their own country of residence. Managing your investment portfolio as an expat requires a nuanced approach. First, let's talk about risk tolerance. The risk tolerance may change when you move abroad due to factors like currency risk, geopolitical considerations, cost of living changes, and changes in your overall financial goals. To assess your current risk tolerance, consider 1, your time horizon. How long until you need to access the funds? Have you thought about when you would want to retire? Or maybe you're already retired and need immediate income to fund your lifestyle. 2 is your financial goals. Are you saving for a specific purpose or for just general retirement income? A specific purpose might be for your child's education or for a home purchase or something else along those lines that requires a lump sum. 3 is your comfort with market volatility. How do you react to market up and downs? Emotions can often get in the way of investing, causing many nervous investors to sell at the market's bottom, which can be the most detrimental thing for your portfolio. For those investors that know this about themselves, it can be significantly more effective to have a portfolio with lower volatility, even at the expense of some future gains. It's crucial to align your investments with your financial goals. If you're looking for a lump sum in the future, buy a property or do you need to generate monthly income, your retirement strategy should reflect these goals. Currency considerations are also important. As a US expat, you're likely dealing with multiple currencies, especially the US dollar and your home country's currency. Your investment portfolio should be structured to manage currency risk and potentially take advantage of currency diversification. For example, if you have a property purchase coming up, buying a futures contract for that amount can help stabilize the amount in dollars you'll spend so you can plan around this. Behavioral finance really plays a significant role in investment success, especially for expats who may feel disconnected from the US-based investments. If the market experiences volatility, are you more likely to panic and sell or see it as a buying opportunity? Understanding your own tendencies can help you create a portfolio that you're comfortable maintaining for the long term and not make immediate knee-jerk reactions. Remember, a well-diversified portfolio can help manage risk. This might include a mix of US and international investments, as well as different asset classes like stocks, bonds, and potentially real estate or other alternative investments. At our firm, we specialize in serving US expats such as yourself. We offer customized portfolio solutions starting at $400,000 or standard portfolios depending on your scenario, starting at $100,000, tailored to the unique needs of Americans living abroad. One of the key services that we provide is access to US bank accounts while using your international address. It solves one of the major pain points for expats, maintaining a US financial relationship without resorting to using a US address with the problems I mentioned earlier. We're also fully licensed globally, including in the United States. This means we can continue to serve you seamlessly, even if you decide to move back to the US or to another country. Our global perspective allows us to navigate the complex intersection of US and international financial regulations. This also allows for the ability to continue in US based asset classes such as ETFs or mutual funds. Our team understands the unique challenges you face as expats, from managing currency risk to navigating international tax treaties. We're here to help you make informed decisions about your retirement accounts and overall financial strategy. Remember, every expat situation is extremely unique. What works for one person might not necessarily be the best solution for another. That's why we offer personalized advice tailored to your specific circumstances, goals, and the particularities of your country of residence. Now, I would like to open up the room for some questions. I already have received some questions in advance from a couple of people, and so would love to answer those first. First question being, am I allowed to invest my US dollars in American platforms if I'm technically a tax resident of Spain? So I covered this a little bit in the presentation, and the answer is yes, right? But it makes it a whole lot easier if you still invest within the United States. You just want to make sure that you're with an institution that is compliant both in Spain and in the US. Which is certainly something that we can help with. But again, maintaining and custodying your assets in the United States can really avoid a lot of other issues surrounding international investments for US citizens. Specifically, if you ever hear the term PFICs, or passive foreign investment companies, it is something that as Americans, we need to stay away from. The tax reporting costs on those are just incredible. And something we want to stay more than arm's length away from. Let's take the next question. Is it more strategic to invest in US dollars in the US and worry about the exchange rate and taxes later in like 30 years? Or is it better to transfer it now into euros and invest via European platforms? Well, I did just address a little bit of that. I would say that it's certainly more strategic to invest in dollars or in a diversification of currencies while still being in the United States, which you're certainly able to do. Even though it's in the US, it doesn't necessarily be invested in US dollars. And especially getting a global ETF or other similar investments that you still get global exposure, even as your assets and investments are custodied within the US. Let's see, let's take the next one. Is it strategic to invest in both countries simultaneously? Dollars in the US and euros in Europe. Well, again, that's going to be fairly similar, right? Is currency diversification is extremely important. If you do have big purchases coming up, like I mentioned in the presentation, we definitely want to make sure, right, that there's not a large currency fluctuation that happens before then. I always recommend buying a futures contract, which is essentially locking in an exchange rate for a point in time at some point in the future, whether that be a month or a year. And so that way, when you buy that, let's say 300,000 euro property, you know exactly how many US dollars that you'll need to pull from your investment account ahead of time. And so you can really plan around that, as opposed to a big change in the exchange rate right before you purchase that property. And all of a sudden you need much more US dollars. Well, I think that's going to be all the questions for today. But certainly thank you for joining. If anyone has any other specific questions about your home country, please reach out for a free consultation. Thank you again for joining. See you later.